Empires do not collapse in chaos at first. They decline in patterns so gradual that most citizens barely notice the transition. History does not repeat with perfect symmetry, but it rhymes with unsettling precision. Different flags, different languages, different centuries, the same structural arc. Power rises through productivity, it consolidates through finance. It stretches through confidence, it strains through debt. And eventually, it transforms. The United States is not facing collapse tomorrow. But when we study the recurring seven-stage empire pattern that has defined Rome, Spain, the Dutch Republic, every empire rises on tangible output, not leverage. Expansion of real capacity. The early Roman Republic built roads and trade networks. The Dutch built shipping and global commerce infrastructure. Britain industrialized the world through manufacturing and steam power. For the United States, this stage was explosive. From the late 19th century into the mid-20th century, America transformed from a developing nation into the world's dominant industrial force. Railroads unified the continent. Steel output surged. Automobile production scaled mass manufacturing. Oil extraction powered global mobility. Later came aviation, telecommunications, computing, and eventually the digital revolution. The country produced more than it consumed. It exported capital goods. It built infrastructure at a historic pace. Productivity gains lifted wages and living standards simultaneously. Debt during this phase was manageable because growth consistently outran borrowing. Expansion paid for itself. Confidence was earned through output, not policy support. Stage 2 follows naturally from productivity dominance. Financial supremacy. Once a nation becomes indispensable to trade, its currency becomes indispensable to settlement. After World War II, the dollar anchored the Bretton Woods system and became the center of global finance. Reserve currency status is an extraordinary privilege. It allows a country to borrow in its own currency. It ensures global demand for its debt. It lowers borrowing costs structurally. Other nations hold your bonds as reserves. Trade settlements reinforce your financial system. This phase amplifies power, capital flows inward. Asset markets deepen. Financial institutions expand globally. Borrowing becomes easier. Deficits become less threatening. Confidence grows not only in production but in monetary stability. When borrowing is easy, discipline weakens. Credit expands faster than real output. Debt grows faster than GDP. Financial markets become central to economic life. Real estate appreciates steadily. Equities trend upward over long cycles. Manufacturing gradually becomes a smaller share of economic output relative to financial services. Wealth becomes increasingly tied to asset ownership rather than wage growth. Leverage spreads through households, corporations, and government balance sheets. Growth still appears healthy, but the composition of growth shifts. Asset appreciation begins supporting confidence more than productivity gains. For the United States, this transition accelerated in the late 20th century. Financialization expanded. Credit became widely accessible. Debt-to-GDP ratios began a long upward trajectory. Stage 4 introduces global overextension. Empires at peak confidence extend influence outward. Military commitments multiply. Strategic alliances expand. Overseas presence becomes permanent rather than temporary. Rome extended its borders across Europe and the Middle East. Britain managed colonies spanning continents. The United States maintains global military infrastructure across dozens of countries. Defense spending remains structurally high. Strategic obligations persist across multiple regions simultaneously. This is not inherently destabilizing. But it is expensive. Investment priorities shift toward maintaining global presence rather than expanding internal capacity. Borrowing funds both domestic and international commitments. Debt accumulates not only to stimulate growth, but to preserve dominance. This is where structural tension begins building beneath visible strength. Stage 5 is the pivot. This is the stage where debt saturation emerges, where interest payments begin competing directly with productive investment, where growth slows relative to obligations, where demographics intensify fiscal strain, where policy flexibility narrows. Federal debt has reached historic highs relative to economic output. For years, near-zero interest rates masked the burden. Servicing costs remained artificially low. The system could tolerate expanding deficits without immediate stress. But once the Federal Reserve raised rates aggressively to combat inflation, the arithmetic shifted. Interest payments rise not because new programs expand dramatically, but because the cost of servicing past borrowing increases. And when the debt base is large, even small rate increases create significant fiscal impact. Stage 5 does not look like collapse. Markets continue operating. The dollar remains dominant. Military strength persists. Technological leadership remains visible. Interest expenses begin consuming larger portions of the federal budget. Deficits persist even during periods of economic expansion. Entitlement spending grows automatically due to aging demographics. Political polarization intensifies, making coordinated reform more difficult. High debt amplifies sensitivity to interest rates. Monetary policy becomes more constrained. Raise rates too high and fiscal strain accelerates. Lower them too quickly and inflation risks re-emerge. The corridor for policy becomes narrow. Historically, this stage often coincides with rising wealth inequality. Wage growth lags relative to financial market gains. Social cohesion weakens gradually. Institutional confidence declines. None of these developments signal immediate collapse. They signal transition. Stage 5 can last a long time. It is a plateau of tension rather than a cliff of crisis. The outcome depends on whether structural imbalances are addressed early or allowed to compound. Growth must exceed borrowing cost to stabilize debt ratios. That is the core equation. When interest rates exceed economic growth persistently, debt burdens intensify unless primary surpluses are achieved. Achieving sustained primary surpluses requires difficult political trade-offs. This is why Stage 5 is decisive. It is the moment where arithmetic becomes unavoidable. The United States retains extraordinary strengths: deep capital markets, reserve currency dominance, technological innovation, entrepreneurial culture, military capacity, energy resources, institutional continuity. These factors provide resilience. But resilience is not immunity. High leverage magnifies outcomes. Strong growth in a leveraged system accelerates stabilization. Weak growth accelerates strain. The 7-stage empire pattern is not prophecy. It is structural analysis. It does not claim inevitability. It identifies recurring sequences driven by debt, growth, demographics, and confidence. Stage 5 is not the end of the story. The next stages depend not on rhetoric, but on arithmetic, and on whether reform outpaces compounding pressure. History suggests that empires rarely fall because of sudden external shocks alone. They weaken internally through obligations that outgrow output. When growth slows and debt compounds, flexibility erodes. The United States remains powerful. But power in Stage 5 is constrained power. Stage 5 is where strength and fragility exist at the same time. From the outside, the empire still looks dominant. Markets are deep. The currency is trusted. Military reach is global. Innovation continues. But internally, the structure becomes more sensitive. Small shocks create larger consequences. Policy errors carry heavier costs. The defining feature of this stage is constraint. Constraint shows up first in the budget. When interest payments rise faster than tax revenue, priorities begin competing with each other. Defense, healthcare, infrastructure, research, social programs all depend on fiscal capacity. As more revenue is directed toward servicing past debt, less remains for forward investment. The empire shifts from expansion to maintenance. Maintenance is not decline, but it is not acceleration. For decades, low interest rates delayed this reckoning. Borrowing was cheap. Debt service was manageable. The illusion formed that deficits did not matter because refinancing was painless. But when inflation forced the Federal Reserve to raise rates aggressively, the system's sensitivity became visible. The cost of money changed. And when the cost of money changes in a highly leveraged system, everything changes. Every $1 trillion of debt refinanced at higher yields compounds pressure. The larger the debt stock, the more dramatic the effect. This is why Stage 5 feels stable until suddenly it does not. Compounding operates quietly before it becomes obvious. At the same time, entitlement obligations expand automatically. Aging populations increase healthcare spending. Retirement systems draw more heavily from the federal budget. These are not discretionary line items. They are embedded promises. Reducing them requires political will that is difficult to assemble in polarized climates. So borrowing continues. This is how Stage 5 becomes self-reinforcing. Debt increases sensitivity. Sensitivity increases caution. Caution discourages bold reform. Delayed reform increases long-term pressure. The cycle loops. Meanwhile, productivity growth remains uneven. Innovation at the technological frontier continues, but broad-based productivity acceleration has slowed compared to earlier eras of industrial expansion. Without strong productivity growth, economic expansion struggles to outpace rising obligations. The critical equation remains simple: growth must exceed interest costs over time. When growth persistently lags borrowing costs, debt ratios rise unless offset by primary surpluses. Sustained primary surpluses require either spending cuts, tax increases, or rapid growth acceleration. None are politically effortless. Stage 5 therefore places pressure on institutions. Monetary policy becomes constrained by fiscal realities. Raising rates aggressively to combat inflation risks accelerating debt service burdens. Cutting rates too quickly risks undermining credibility. The corridor narrows. Markets begin pricing this constraint. Investors understand that highly indebted systems cannot tolerate extended periods of elevated rates. They anticipate eventual easing. This expectation shapes asset prices. It shapes risk-taking behavior. It shapes capital allocation. Over time, financial markets become intertwined with policy support. When volatility spikes, intervention is expected. When growth slows, stimulus is anticipated. Liquidity becomes part of the structural framework. This dynamic influences behavior at every level of the economy. Corporations leverage balance sheets under the assumption that credit will remain accessible. Households tie wealth expectations to asset appreciation. Governments rely on refinancing rather than reduction. None of this signals imminent collapse, but it signals fragility beneath strength. Stage 6 begins not with chaos but with doubt. Doubt spreads slowly at first. Foreign investors diversify marginally. Trade partners explore settlement alternatives incrementally. Currency swaps increase. Bilateral agreements reduce marginal dependence on the dominant reserve system. None of these actions individually threaten the core currency. Together, they reflect long-term hedging. Reserve currency transitions historically take decades. Sterling did not lose dominance overnight. Confidence faded gradually as the fiscal and economic center shifted. Today, the dollar remains deeply entrenched. Global commodities are priced in it. International reserves are held in it. Financial contracts depend on it. But debt sustainability influences long-term credibility. If investors believe fiscal trajectories are stable, confidence persists. If trajectories appear permanently imbalanced, risk premiums rise. Rising risk premiums increase borrowing costs. Higher borrowing costs accelerate fiscal strain. Fiscal strain reinforces doubt. This is how Stage 6 emerges organically from Stage 5. The decisive variable is reform capacity. Can the system generate sustained productivity growth? Can fiscal policy stabilize debt ratios gradually? Can entitlement obligations be recalibrated before markets impose abrupt discipline? Can political polarization soften enough to enable coordination? History shows that renewal is possible. Empires are not predestined to collapse. They adapt or transform. Britain shifted from industrial dominance to financial specialization. Its global political empire receded, but its financial influence persisted. Rome fragmented, yet its legal and institutional frameworks shaped future civilizations. Transformation is not extinction. But transformation rarely occurs without pressure. Stage 5 is the window of voluntary adjustment. Stage 6 is the beginning of market-enforced adjustment. Stage 7 is restructuring. The United States remains in Stage 5. It still retains enormous structural advantages. It leads in technological innovation. Its universities attract global talent. Its capital markets are liquid and deep. Its energy resources strengthen resilience. Its military capabilities provide strategic influence. These strengths provide time. But time is not the same as immunity. High leverage magnifies outcomes. Strong growth in a leveraged system produces rapid stabilization. Weak growth produces accelerating strain. The margin between those outcomes narrows as debt compounds. The empire collapse pattern is not about fear. It is about sequence. Stage 1 builds capacity. Stage 2 builds privilege. Stage 3 builds leverage. Stage 4 builds commitments. Stage 5 builds constraint. Stage 6 builds doubt. Stage 7 builds transformation. The United States stands at the constraint phase. Constraint is not defeat, it is decision. The next decade will determine whether constraint leads to renewal or erosion. Renewal requires confronting arithmetic directly. Growth must consistently outpace interest costs. Fiscal credibility must match monetary credibility. Structural reforms must occur before markets demand them abruptly. Drift, by contrast, allows compounding to decide. History suggests that empires rarely collapse because they are attacked at their peak. They weaken internally through imbalances that persist longer than expected. External pressures then exploit internal fragility. The United States remains powerful. But Stage 5 power is conditional power. It depends on sustainability. And sustainability depends on one law that has governed every empire before it. Debt cannot outgrow productive capacity forever. When that balance holds, dominance persists. When it breaks, transformation follows. The pattern is not destiny, but the arithmetic is real. And Stage 5 is where arithmetic begins demanding answers.